We got rate cuts. We got federal rate cuts. Is that going to save gaming? Is that going to make the industry rebound?
Here's what I'll say.
Saving us?
Yeah, Jay Powell saving us. Here's what I'll say. If you want intelligent analysis or good fact-based discussion, you can now leave the pod, because we're going to go into wild speculation territory where, while Warren and I both are not at all economic experts, especially as it relates to Fed policy and Fed rate cuts.
And I have a portfolio of rotting orc NFTs. You don't want to like take my advice on like the Fed's macroeconomics.
So we're really going to shoehorn this big news topic into how it affects games. For those of you who lived on a rock or don't pay attention to the financial press at all, the Federal Reserve cut interest rates by 500 basis points, so that's 0.5%. This was yesterday, making this the first rate reduction in over 4 years. This reduction reflected the Fed's confidence that inflation was declining while still aiming to maintain a healthy labor market. The decision was influenced by revisions to the employment data and concerns about downside risks to the economy. The Fed's action was viewed as a significant step to recalibrate monetary policy after a prolonged period of tightening. That's what ChatGPT told me. Hopefully it's right. I'm pretty sure it's right. I double-checked it. Anyway, so rates are going down. I mean, this is something that affects everyone in our day-to-day lives. I mean, this means if you want to go borrow money to buy a car or buy a house, rates will go down. And if you're buying treasury bonds with your excess cash, that rate will go down. So there's a lot of reasons why this will affect individuals. And so we want to talk a little bit about how this could affect the game market. So we're broken this out into 5 sections, and we'll just sort of do a quick discussion of each. I will say this is going to be a lot of touchy-feely. Number one people thought is that traditionally rate cuts increase consumer spending. And if you look historically, that data is very, very true. However, one thing that I would like to call out is the fact that American consumers have been spending beyond their means for quite some time now. This is a view that I pulled, and this is actually specifically consumer credit card debt in the US, which just passed $1 trillion for the first time ever. And another view that I don't have here, but sort of you can overlay on this, is people are drawing down their savings at a pretty drastic rate, and they're at very, like, some of the lowest saving rates we've seen in recent history. One other trend, which is I should have probably pulled a better view for, is the fact that if you look at overall consumer debt, not just credit card debt, we're at all-time highs, and basically the compounding effect of student debt, mortgage debt, car payments, credit cards, and other debt is basically showing that the American consumer is completely debt-ridden at a time when they're drawing down their savings. So I think cutting rate cuts will help. Obviously, those debt rates will come down over time, so there will be increased consumer spending, but I'm also fairly pessimistic that the average American consumer isn't feeling the pinch, and I'm not sure that how much excess cash is going to flow through to the games industry.
Yeah, I could make a case on either side of that.
Sure.
Xander, I could say, consumers are showing, even despite high rates, they degaff, and they're going to keep spending on things that they don't necessarily need. Conversely, we could say the consumer is exhausted. People are, spending well above their needs, and the first thing they're going to be cutting are discretionary items such as extra gems in their favorite video game, which, I actually, if anything, maybe lean more towards the latter. I mean, we saw the inverse of this during COVID in a pretty legendary way. People got checks, they got free money. We're in the ZERP era, and we saw like LTV and the games we were working on just skyrocket during that period. It was clear people had extra cash in their pocket and were spending it a little more recklessly. So my gut is we're going to continue to kind of see that inverse trend continue.
Yeah, I'd say we move sideways. I think the number one thing that's the core difference now between then, and I wish I put together a better graph for this, is that saving rates were at all-time highs or recent highs during COVID, whereas now they're at recent lows. You can spend money when you have high savings and when you're at all-time high debt and no savings. I mean, where's the money coming from, right? It's coming from your meal or something. And so we'll see. I think you're right. I mean, the whole intent of cutting the rates is to spur consumer spending, among other things. And so it's very possible. I mean, we'll have to see. We're not economists. Number 2, M&A. Lowering borrowing costs will undoubtedly lead to more M&A. I think that's self-evidently true. I think that's even more so in the current era where we're seeing a bifurcated market where you have sort of haves at the top, strong balance sheets, large economy to scale, and then sort of the chunky middle, these companies really struggling, consolidating, downsizing, closing, and then sort of the small up-and-comers at the bottom who I actually think are very well positioned to get the cost structure right as they build new game companies. And what I anticipate to see is people at the top, and we've actually seen this quite a bit over the last decade, will continue to slurp up stuff, sort of the chunky middle, and or the chunky middle will die and or consolidate. And so that's sort of what I expect to see. And I think this is not a hot take. This is a continuation of what we've seen the last 2 years. But Warren, any thoughts on M&A and how the rate cuts will affect that?
Yeah, I think this might not sound like there's a direct line to like how this affects the gaming segment, but there's actually, first of all, this is very real. An absolute fact that like deals that were being approved like a few years ago, like banks were just not funding the same kind of deals in the same way in more recent years. How does this affect smaller companies? Like when there is a cooler M&A market, we see young companies growing less aggressively because we've talked about this in the pod in the past. If there is not a path for your business of like likely acquisition around top line growth or user growth, like the more, I don't want to say just pure vanity, but like the less sustainable kind of growth, you've got to be a lot more cautious. And like back to the concept of lean growth that we talked about in the up top, plug again for our webinar, we're still in that era. Like we're not seeing the wild days of small and medium-sized gaming studio M&A. And that just means that like everyone is investing more cautiously, back to like these ideas of smaller marketing budgets. And it's the complete inverse of what we saw in the 2010s. Teams spending super aggressively, legendary 100-person plus user acquisition teams like Machine Zone had.
Yeah.
A lot of these things were not net profitable. They were growth stories in plan in pursuit of some sort of exit, some sort of the bill being picked up by some larger entity. As we go out of the high interest rates phase, I think we're going to gradually ease back into a bit of M&A happening. I mean, the cutting 50 basis points isn't going to set the world on fire and like restart M&A. But I think it's going to have people kind of start coming out of their holes and this segment starting to activate again.
Right. And this is supposed to be the first in a rate cut regime. Is it expected, from my, again, amateur understanding, is that we expect to see another couple full percentage points of rate cuts or thereabouts within the next couple of years. And so, maybe at 5% or whatever, it's not a huge deal, but at 3.5%, maybe this really, really accelerates. And so this is something that we could ramp to over time. And that sort of jumps to the next topic, which is increased game development investment. This is another theory. It's like money's cheaper. We're going to have more game development investment. I think that's probably a credible thought. The juggernauts at the top of the industry, the ones we were talking about earlier, if money's cheaper, they'll probably build more. That being said, I mean, a lot of these companies, these are incremental step downs. This isn't going to happen overnight. And a lot of these companies, they need to be investing in game development anyway. So it's hard for me to sort of understand. And maybe it's me just being like, I don't know. But it occurs to me that the people who need to be investing in game development need to be doing it regardless of whether or not the rates are coming down. The rates coming down will make it cheaper and easier for these companies to do it. But that being said, I imagine the folks who are doing the investment are probably doing that anyway and need to be doing it anyway. And this will make it easier over time, but they're probably, at least to some extent, doing the investment now as it is. And we'll continue to see that sort of go forward, because the alternative for these companies is they die, right?
Yeah, I think it's pretty straightforward. I mean, as the cost of capital comes down, history shows that like people will take two things: willing to make longer term investments and also willing to make riskier investments. So I think this at every level we'll see increasing investment in game development. So like at the larger cap companies, we're going to see that they'll maybe be more willing to invest in longer term projects, in expanding like new IPs and things like this. And for gaming startups, I think the funding rounds will start to open back up, and we'll start seeing gaming startups founded in a way that we've seen a lot less of the last few years. So I think this part's pretty straightforward.
Yeah, I don't disagree whatsoever. I think my question is more around the scale and what velocity do these changes take place. And I think it's going to be a function of how fast we see rate cuts drop. We have seen a lot of dry powder on the side, but for the people where this is existential, they need to be investing now. They probably are investing now. Okay, next up, stock market impact. The stock market tends to have a short-term rally after Fed announces cuts. That's happened. If you look at the stock market, sort of nominal rally so far. The main thing is I think that these rate cuts were not unexpected, so a lot of the cut cycle is already baked in. So I don't know how much of a boon the short-term stock market rally is going to be. The question, I think that's way more on my mind, and I think what people need to be concerned about is whether or not we are slipping into a recession. And that, I think, would be the thing that really is going to have one, negative impact on the stock market, and two, have a serious impact on the games ecosystem overall as people have less discretionary income.
Yeah, maybe to put another way, so as number go up in stock market, it's easier for teams to raise funds via selling shares, right? I think that's the main thing we're getting at. But that's inevitable, and also I think pretty straightforward. I think the other impact relative to the stock market, back to an earlier point, as we get more risk on with rates lower, we'll just see valuations like gaming isn't where people run when there's like fear of world war, right? Like they're buying gold and oil. But as rates go down, we generally see that risk spectrum again increase, and we should see, if not immediately, like as that cycle goes further along, increasing positive impact to gaming as a sector.
All right, last one. This is a little niche one, but one that's really near and dear to our hearts. UA funding costs will go down as part of a component of the rates coming down over time. This is really good for a segment. It's relatively small relative to the other giant macro factors we talked about, but the cost of UA funding going down can be a huge advantage for advertisers who have a good product but don't necessarily have the balance sheet to fund growth against that product. And as UA funding comes down, their margin and availability of capital comes down, which means that many of these games and apps can invest at a profitable rate and grow and scale. And that's something that I think is, undeniably true. And while maybe nominal relative to the big macro factors we talked about before, I think it's still important to call out from the game's growth perspective because it's really relevant.
Yeah, this one is super niche, but super direct. So apologies for anyone who doesn't give a about this one. But like when we're talking about UA funding, there's these subset of businesses, like for a couple names, like Bravo Capital is an established one. Tilting Point, they have, played in the UA funding space. Sandlo is another team we're friendly with that is played in this space. These are essentially like creative funding mechanisms that are tied to how free-to-play economies work, where you can essentially get a loan and have that tranche paid back by your player cohorts as they come in. And usually the funding providers will take directly from your user revenue as those players come in. So it's kind of like a funding innovation developed for free-to-play economics and how those games have to scale, and the concept that like, yeah, I'm paying for a user today, but I'm not selling them a box off a shelf. Like I'm getting that payback over 3 months, 6 months, 2 years. And so funding mechanisms that go along with that. So that's all to say, at the end of the day, it's arbitrage. Like, can I take a loan out and will I get higher margin on my user acquisition profitability than what I'm paying for this loan? As those rates come down, there's less burden of profitability on your user acquisition and growth marketing work, and you can be more aggressive with it. So this one's super niche, but I think maybe the most straightforward because it ties absolutely directly to rates and rate arbitrage.
Agreed. All right, that's our non-professional analysis of the rate cuts and how to affect gaming.
We have been putting together some content that we would like to share with everyone next week, and it is called the Lean Growth Webinar. So what is the Lean Growth Webinar? It's been like a tumultuous couple of years for the game industry. Been a lot of budget cuts, layoffs, lots of bad news in the industry in general. And so it's just meaning teams have to do more with less. They have smaller teams, smaller budgets, less tools and software that they're able to license to do their jobs. So we want to do something really focused on how can teams be really efficient and lean? What are the pieces of technology and sort of like the team structure and philosophies you can take to make a really lean and efficient growth team. So join us for the Lean Growth Webinar. That is next Wednesday, September 25th.
10 a.m. PST. You can register in the description.